Mortgage contingency in the contract of sale basically, on the simplest terms, says if the purchaser is not able to secure a mortgage commitment from a lender for X amount of days following the fully executed contract of sale, if the purchaser is not able to secure that commitment from the lender, that means that as long as the purchaser in good faith applied for that mortgage and they did not get it, the purchaser will be able to terminate and back out from the deal. They will be able to back out from the deal and get their deposit returned to them. In New York, the way it's done is once the contract of sale is fully negotiated, the purchaser signs and sends their deposit to the seller, in which the seller countersigns, right? So once the contract is fully signed by both the purchaser and the seller, and there's a mortgage commitment contingency in there, if the buyer is not able to secure a commitment from the bank, where the bank says, we will give you a loan at closing, the buyer's not able to secure that letter, they could back out from the deal and get their deposit back. Now, be very careful with this because a mortgage contingency is simply that. It just says as long as a buyer gets a mortgage commitment from the bank, they are locked into the deal. There's also something that's called a financing contingency, which goes hand in hand with the mortgage contingency. What a financing contingency does, it says, okay, buyer was able to secure their loan commitment from the bank. Great, right? Because once the buyer does that, they're locked into the deal. What a financing contingency says is buyer gets their commitment, they get a commitment from the bank. Now, let's say a week before the closing, after the buyer already secured the mortgage, let's say a week before the closing, somehow, some way, the bank goes bankrupt. They don't have any money to disperse, nothing. Let's bring it back to January or February 2023 when Signature Bank and all these local banks collapse, right? What happens in a situation like that, where as a buyer, you were expecting to receive a loan from a bank, but this bank doesn't have any money to give you at the closing? That is where the financing contingency comes into play. It's very important. And it says, if the lender, if for whatever reason the bank, except for buyer's own fault, is unable to fund the closing of the property at closing, the buyer will be able to back out with this funding contingency. If the funding contingency is not there in the contract and the buyer secured their commitment, and a week before closing, the buyer's bank forecloses on itself, that's it. The buyer still needs to proceed to closing, whether it's with cash or if a buyer could secure another loan within a week with another lender, right? So you never want to get into a situation where, as the buyer, you were placed into the situation where you have to pay with cash. You don't want that situation unless from the beginning of the deal, it is communicated to the seller that the buyer wants to proceed with this deal with cash, which brings us to another situation, right? The buyers could always proceed with purchasing a property with cash. They don't need to get a mortgage. They don't need that mortgage. Obviously, it helps them depending on the circumstances of the buyer, right? But just note that just because the buyer says they want to purchase the property with all cash, that doesn't mean that they cannot get a mortgage, right? They could always get a mortgage. If you're getting a mortgage, make sure you're on top of the timeline of the contract, right? Because usually contracts, they will call for a closing of, let's say, 60 days from the day that the contract was signed. These days, post-COVID, sometimes it takes 45 to 60 days to receive a mortgage commitment. You need to take those dates into play and make sure you're on top of the timeline.